Before we go further, here's what the Fed is actually trying to do. The Fed doesn't print money the way you think. Most of the time, it doesn't fire up a giant printer and flood the economy with cash. It flips switches in the plumbing of finance, changing the price of money, the availability of liquidity, and the incentives banks and markets face. That's why the Federal Reserve isn't really a bank in the normal sense. It's closer to a switchboard. It routes power through the system, raises or lowers voltage, and tries to keep the whole grid from blowing a fuse. Now let's talk about the first switch the Fed flips: interest rates. Legally, the Fed isn't designed to make you richer or punish savers. It has a mission: promote maximum employment, stable prices, and moderate long-term interest rates. In plain language, it's trying to keep the economy running near its steady speed without overheating into inflation or stalling into recession. That sounds simple until you realize the Fed doesn't control the economy directly. It can't order businesses to hire. It can't command landlords to stop raising rents. It can't force productivity to grow. What it can do is influence financial conditions: how expensive it is to borrow, how easy it is to get credit, how attractive it is to hold dollars, and how confident people feel about the future path of inflation. So the Fed is always operating with imperfect information and a lag. The data it sees reflects decisions made weeks or months ago, and the effects of its actions often hit months later. That's why the Fed talks so much about expectations. If people believe inflation will cool, they negotiate differently, price differently, invest differently. In a modern economy, beliefs can move outcomes almost as much as policy. But rates aren't the whole story. There's a second lever: the Fed's balance sheet. The Fed's primary lever is short-term interest rates, specifically the federal funds rate, which is the overnight rate banks charge each other. But the Fed doesn't set this rate like a store sets a price tag. It guides the rate into a target range using a corridor floor system. Here's the simple version. The Fed controls the conditions under which banks can park money safely. It pays interest on reserves that banks hold at the Fed, often called IORB. If the Fed pays banks, say, 5% to hold reserves risk-free, banks won't lend those reserves to other banks for 3%. That interest rate becomes a floor under market rates. Then there's the overnight reverse repo facility, which offers money market funds and certain institutions a safe place to park cash at a Fed-linked rate. That helps reinforce the floor across the broader short-term funding market, not just between banks. When the Fed raises its target range, it's raising the baseline gravity of finance. Safe rates go up. That pulls up yields across treasury bills, bank deposits, and short-term loans. Suddenly, borrowing is more expensive, and saving is more rewarding. Credit growth slows. Risk appetite cools. This is the switchboard effect. The Fed changes the incentive landscape, and the system reacts. Okay, so how does that wiring reach the real economy? Jobs, prices, and your bills. The second lever is the Fed's balance sheet, what it owns and what it owes. When people say money printing, they're usually describing this channel. During crises or deep recessions, the Fed may buy large quantities of treasury securities or mortgage-backed securities. This is often called quantitative easing, QE. Mechanically, the Fed pays for those assets by creating bank reserves, digital entries on its own liabilities side. Reserves aren't cash in your wallet, but they are high-powered settlement money inside the banking system. QE tends to push down longer-term yields, support market functioning, and signal that the Fed will keep policy accommodative. The reverse is quantitative tightening. The Fed shrinks its holdings by letting securities mature without replacing them, or by selling assets. That removes reserves over time and can push financial conditions tighter, especially if liquidity becomes scarce. Then there are emergency liquidity facilities tools that look less like macro policy and more like firefighting. In stress events, the Fed can lend against collateral to prevent a temporary liquidity squeeze from becoming a chain reaction. Think of these tools as surge protectors. They aren't meant to create a boom. They're meant to stop a short circuit from taking down the grid. And here's the part most people miss. Every move has side effects. So how do these switches reach your life? First, credit. Higher short-term rates lift borrowing costs for credit cards, auto loans, and business lines of credit. Banks tighten lending standards. Marginal borrowers get cut off. Expansion plans get delayed. Second, housing. Mortgage rates are heavily influenced by longer-term yields and expectations of future Fed policy. When rates rise, monthly payments jump, affordability drops, transactions slow, construction cools, and the wealth effect from rising home prices can reverse. Third, the dollar. Higher U.S. rates often attract global capital into dollar assets, strengthening the dollar. A stronger dollar can lower import prices, helping inflation, but hurts exporters and tightens conditions for countries and companies that borrow in dollars. Fourth, asset prices. When safe yields rise, the discount rate on future cash flows rises. That can compress valuations in stocks and real estate and reduce speculative activity. Conversely, when rates fall and liquidity is abundant, risk assets tend to re-rate higher. Finally, expectations. This is the quiet channel. If businesses believe the Fed will crush inflation, they may slow price hikes. If workers believe inflation will persist, they demand higher wages. The Fed spends enormous effort communicating because messaging can move financial conditions today without waiting for the next meeting. So what should you actually remember without the jargon? Every switch has side effects. Tightening policy can cool inflation, but it can also raise unemployment and break weak balance sheets. Rapid hikes can expose hidden interest rate risk in banks, funds, and leveraged borrowers. On the other hand, prolonged easy money can inflate asset bubbles, encourage excess leverage, and widen inequality as asset owners benefit more than wage earners. There's also the political edge. When government debt is high, markets may wonder whether the central bank will face pressure to keep rates lower to ease fiscal costs. That's the fear of fiscal dominance. Even if the Fed remains independent, the perception alone can affect inflation expectations. And importantly, the Fed's tools work unevenly. Some people feel rate hikes immediately. Credit cards, mortgages. Others feel them later. Job market. That uneven timing fuels confusion and conspiracy narratives about what the Fed really does. If you remember only one thing, make it this. The Fed is a switchboard, not a regular bank. Here's the takeaway. Stop thinking of the Fed as a normal bank that lends money or prints cash in a simple way. Think of it as a switchboard for financial conditions. Rule 1. Rates change incentives fast, what it costs to borrow, and what it pays to be safe. Rule 2. The balance sheet changes liquidity, and long-term yields more like adjusting the system's pressure. Rule 3. Transmission is indirect and delayed, which is why the Fed talks so much and still gets blamed for everything. The Fed doesn't control the economy. It controls the wiring that connects finance to the real world, and that wiring is powerful enough to cool booms, deepen busts, and sometimes save the grid from collapse.